And now for something. And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Wednesday. It's hump day as we kind of get through this second week of November. And look, the Thanksgiving holidays are coming up here, and already markets are beginning to get a little bit more volatile. And we've been talking about this over the last couple of weeks that, you know, the markets were very extended and very likely to have a pullback. And so yesterday, everybody's all, you know, kind of worried on the mainstream media because headlines this morning on CNBC is that stocks snap 8-day win streak. Yeah, that's going to happen from time to time. Stocks just don't go up. They actually do go down every now and then. Not by much, but they do go down. Yesterday, the market was down about 33 bips. You know, just a very small, about 1/3 of 1%. You know, nothing major. It was almost entirely driven by shares of Tesla. In fact, with Tesla now being the third largest market cap weighted stock in the S&P, its outsized decline yesterday is actually what drug down and actually contributed to almost the entirety of the entire decline in the index yesterday, that 33 basis points. So again, big decline there yesterday in Tesla shares. This, of course, following the vote that Elon Musk had put out on Twitter saying, you know, should I sell some of my shares to pay capital gains tax? And, you know, the reality is he takes no salary, he has no bonus, so the only way he can pay for things is to sell shares. So he needed some money for whatever reason, needed to pay bills or buy a house or a jet, whatever he wanted the money for. You know, he said, hey, can I sell 10% of my shares? 57% of people on Twitter said, yeah, go ahead, sell your shares. And he did, and that dragged the stock down about 10% yesterday. It was down also the day before, on the day of the poll. The Tesla shares were also down. But yesterday, apparently he sold yesterday. Either he did or somebody else did, but the stock was down quite markedly yesterday. And again, that pretty much accounted for the entirety of the entire drag of the index. Now, the good news is if you're long Tesla shares, it is sitting right on the 20-day moving average. So there should be a little bit of support here for the stock. A violation of about $1,000 on Tesla shares is going to look to see a decline probably down to around $850, $860 a share as well. So again, if you're long Tesla shares, depending on where you bought them, these were well due for a pullback here. The stock was trading more than 4 standard deviations above its long-term moving averages and just had a rocket ship run here lately. So again, not surprising. When you have these big outsized moves to the upside, guess what? You get big outsized moves to the downside. The not so good technical news, again, if you're long Tesla shares, did trigger a very serious money flow sell indicator for that. Does suggest that we're going to get a bit bigger pullback. And that sell signal is also confirmed by a crossover in the moving averages as well. So when you look at our MACD, that is kind of the confirming sell signal for the money flow indicator. Suggests that there may be pressure under Tesla shares here for at least a short time frame. So again, if you're long Tesla, have a big gain, you may want to think about taking a little bit of profit off the table, kind of like Elon did. So, you know, never hurts to take a little bit of money so you have cash to spend. Spinning back over, though, taking a look at the market yesterday. Again, you know, the mainstream media this morning a bit kind of beside themselves about the decline yesterday. You know, oh my gosh, there was actually red on the screen for a change. You know, that happens from time to time. Futures are pointing down this morning. We've got big inflation data coming out, CPI this morning, of course. This is the big conundrum for the Fed right now. The Federal Reserve saying, hey, we're not really going to pay attention to inflation. We're going to focus on full employment. But by all measures, we are already back to full employment in the economy. We have, you know, a large number of people leaving the labor force. Labor force participation rates remain very low. But the official unemployment rate and the rate that the Fed looks at is back down to 20-year levels, where normally that's about the average peak of unemployment. We're down to those levels. So really, by all intents and measures, we are at full employment, but the Fed's choosing to ignore the inflation data to keep kind of monetary policy very easy here. They are concerned about valuations in the markets. They just released their financial stability report yesterday, and their number one concern, asset valuations. in that, along with bank credit and others. But asset valuation certainly making the top of the list in the Fed's financial stability report. So again, they are concerned about that. So again, removing monetary policy too quickly would certainly impact stocks, as it always has. But again, we'll see what happens. This inflation number today is going to be very important, because if inflation is running hotter and more persistent, the Fed is going to potentially have to hike rates sooner. And potentially, rather than just 1 or 2 times next year, maybe you have to do 2 or 3 or 4 times next year, depending on how bad this inflation data actually comes in. So again, pay attention to that. That could weigh on markets this morning. Markets, like I said, Dow's down about 70 points right now, with the futures. The Nasdaq's down about 70 points as well. So you're going to see some pressure in technology stocks today. Again, not surprising. They've all had very big runs here lately. But again, MACD sell signals are not in place here. We still, as opposed to Tesla, our MACD buy signal is still very much intact. But we do have a confirmed money flow sell signal here, with money flows really kind of at peak. So again, this correction today kind of aligning with signals here lately. We've kind of talked about the last couple of days, taking some profits, rebalancing risk. That really still seems to be the prudent course of action here. Again, as we've talked about here over the next couple of weeks and into the first 2 weeks of December, you're about to run into mutual fund rebalancing, and this is where they're going to rebalance their portfolios for the end of the year and also make distributions. So that's also going to potentially lead to some of this kind of selling pressure in the markets, because again, as mutual funds start to rebalance portfolios, that's going to lead to selling so that they can make their distributions. That's going to potentially cause this market to potentially, correct here a bit. Again, not surprising and not a big, we're not talking about a crash or anything like this. So again, don't take this as advice to go sell everything and go to cash. Lance said the market's going to crash. I'm not saying that at all. But what I am saying is that markets don't go just up. They do actually go down. And a correction back to the 50-day moving average right now, well within the context of what happens very normally. It's actually been happening all year long. We've come down and retested that 50-day moving average repeatedly ever since January. That's very normal, and that's about a 3 to 4% correction here. So, and again, what investors tend to forget is these 3 or 4% corrections, they feel terrible. The 5% correction that we had back in October, headlines on CNBC were markets in turmoil, and people were like, oh my gosh, is the bull market over? It's like, no, it's a 3% correction. Got to keep these things into some type of kind of framework that you're working on in terms of managing your money. Again, market's very extended here, so a bit of a pullback, not surprising at all. But that would actually set you up for a good opportunity if you have some cash to put that to work on this pullback for the end of the year Santa Claus rally, because despite supply chain disruption, Santa Claus is still coming. And, his little elves are working overtime, and he's going to make his deliveries. But of course, as we get into the end of the year, that's also when mutual funds and Wall Street are starting to position themselves for the end of the year reporting. And that's why we typically get this kind of rally right into the end of the year, right post-Christmas to the end of the year, get this little Santa Claus rally. So again, pull back here, set you up nicely for that. And then once we get into 2022, as we'll talk about with Danny Ratliff here in a little bit, is what the outlook is for 2022, and is the 60-40 allocation model, is that dead, right? A lot of people in the media saying 60-40 it's over. Can't own bonds anymore. You've got to only own stocks. We'll talk about if that's real. Be right back after the break with Danny Ratliff. I'm your host, Lance Roberts. Don't go away.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and markets, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rotho, and Roberts. RealInvestmentAdvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
This morning, I'm Lance Roberts. Of course, it's the Real Investment Show. Be sure you get by our website, realinvestmentadvice.com. This Saturday, I'm going to be joining Danny Ratliff and Richard Rosso for Candid Coffee to talk about the markets, the outlook for 2022, kind of what we're expecting for next year. The good, the bad, and the ugly, so you'll need some coffee with it. So make sure that you go by the website, click on either the events tab right there on the homepage. If you just scroll down, if you go to realinvestmentadvice.com, just scroll down the page a little bit. There's a big banner. And there should also be a pop-up for you as well that you can basically just click and get registered. And again, seating is not really limited. So... there are plenty of seats virtually. This is the great thing about virtual events. Plenty of room for you. Love to have you come in. That's Saturday morning, 8 o'clock. So, got to get up a little early, get your coffee going. But, we'll get you in, get you out, get you on for your day, and get you kind of an outlook for 2022. Also, on our website, we've got lots of new articles out this week. 5 signs that you need to be paying attention to for the markets, and really kind of the idea of markets being exceptionally overbought here from a historical perspective. And what does that potentially mean? So lots of good information for you. Realinvestmentadvice.com as always. Joining me this morning, Danny Ratliff, as always, on Wednesdays. Danny, how are you?
I'm doing great. How are you, Lance?
Fantastic. So a couple of things I want to get into this morning. In particular, one is the 60-40 portfolio dead. We've been hearing this a lot this year. But before we get there, let's talk a little bit about some good things that are happening for savers this morning. If you're aggressively saving into your 401k plans or your IRA or your Roth IRA, there's been some IRS is basically doing something good for us, right?
Yeah, well, they've done a little bit, right? It's kind of a half-baked deal in the sense that they didn't go all the way. So they did increase 401k contribution limits from $19,500 to $20,500. So you can put a little bit more into the 401k. However, they failed to raise what you can contribute into an IRA. So a little frustrating on that. They did raise the income deduction limits from as far as what type of income you can make and still deduct an IRA contribution. So they did increase those a tad bit. So they did a little bit, but they didn't do it all. And so a little bit frustrating on that front. Well, hoping that they come through and actually increase what you can put into the IRA, because $6,000, let's be real here, Lance. Yeah. That's not going to cut it, right?
Well, look, my argument for a long time has been is just take the limits off, right? I mean, people can only save so much money. You've got to have money to live on, right? So, but why do we have limits on 401ks and IRAs? Why not just allow people to save as much as they want? And if I'm in a position to where I could save $10,000 in my IRA this year, great, let me. And I don't really ever understand the limits because, if you take a look at the data, and the data is clear, it's interesting, we see these articles out from Fidelity, more 401k millionaires than ever, more IRA millionaires than ever. that's true until you actually look at the number of IRA or 401k accounts, and what you find is that's the top 1%, right? Exactly what you would expect in the economy. But when you look at the average savings or the median savings of households in 401k and IRAs, it's very small. It's less than 1 year's salary in a lot of cases for many people. And so there's no reason. I mean, if the whole goal is to try to get people to save more so we can take the burden off of Social Security, take the caps off. Let them save as much as they can, right?
Correct. Well, the premise is that they want to get as much money as they can get their hands on, but they're failing to think about the demographic issue that we have. Look at the baby boomer population. I mean, more than half of them will be retired by 2023. So we're on a downhill slope here from that, and they're going to be taking more out from the required minimum distribution. Now, there is also legislation out, which I'm sure you know, that is looking to push once again. It's the Secure Act 2.0 versus Secure Act, which is going to push that RMD back. So the required minimum distribution, what you must take, it used to be 70 and a half. Now it's 72. They're looking to extend that to 75, where you have to start those distributions from your retirement accounts. But let's face it, most of these people need it to live on. Like the numbers you just mentioned, they're all over the place, and most people don't have that much money saved.
Well, and so now there is kind of a couple other things too here. So again, let's go back to what you said, right? The government wants their money now. Okay.
Right.
So, all right, let's take the limits off saving for Roths, right? So, you know, because you get your money now, right? If I put $10,000 into the Roth IRA, that's post-tax. I've already paid tax on money. The government gets their money, and I get to save some money tax-free down the road. Take those limits off. Of course, that'll force more people to probably start saving into a Roth IRA versus an IRA or a traditional 401k. But now we have Roth 401ks as well. So a couple of options there where you could remove limits and allow people to save more money, right?
Correct. No, I think it's a great idea. In fact, you guys heard it here first. Write-in ballot, November 2022. Lance Roberts. Great ideas.
I will fix everything. You may not like them, but I will get them fixed. Social Security, I will fix it. You may not like it, but I'll fix it. Go ahead.
Speaking of Social Security, Lance, there's a lot going on with Social Security and a lot of changes here on the horizon potentially with that, and actually some good things that may come out of this. So Social Security 2100, they're calling it a sacred trust. The House and Ways Committee has already voted on this. Chairman John Lawson, he's gone through this. And so there is actually some good news on that front in the sense that they're going to make some material changes. You know, we've talked about how there's need to be a change with CPI W to CPI-E, so it focuses more on what elderly expenses are. So seniors who are taking Social Security, it's more in line with that. The numbers are staggering when you look at over decades as far as how that is not kept up with inflation. But you know, I think that's going to be a really good thing. So they're looking at a monthly benefit of $30 increase across the board for the average retiree. I
don't know if $30 a month is going to help retirees when you're talking about inflation at 5% and 6%.
Well, but they did do the cost of living adjustment, which was much higher than typical. So that's good news.
with CPI calculations since 1999 under the Clinton administration to try to lower the cost of inflation so we don't have to increase the payment on Social Security benefits because of the underfunded status of Social Security. So really, real inflation, what people live with actually has been far higher than what CPI has reported. So the cost of living adjustment hasn't kept up with that. But even with that suppression of Social Security payouts, starting last year, we're now paying out over 100% of what we collect in tax revenues. That goes specifically just to mandatory spending, Social Security, Medicare, Medicaid, prescription drug benefits, and interest on the debt. More than 100% of our income from tax revenue just goes to that. None of that, nothing else is paid for. That's all coming out of debt. And now we're talking about increasing one of the biggest chunks of the budget, which is Social Security, Medicare, Medicaid payouts, that is already not being covered by tax revenues. So, the debt and deficits that we're dealing with is going to continue to grow. And look, I'm not saying we shouldn't give seniors more money. I'm just saying how are we going to pay for it? Because again, we can't keep living on this kind of debt run structure we've got.
No, you can't. And there's going to
One of the things that you were worried about previously here on the show, we got about 2 minutes, was the potential that some of these new kind of bills from the Biden administration would take away kind of backdoor Roths, but that actually turned out not to be the case, right?
Yep. So far, that it's so good that they're not taking that backdoor Roth away.
Explain for people, what is a backdoor Roth, by the way?
So backdoor Roth is where someone contributes to a non-deductible contribution to a traditional IRA, then later they go and convert that to a Roth. So essentially, you're avoiding the taxation on that aspect because you didn't pay you didn't get a tax benefit when you contributed to the traditional IRA because you likely made too much money. So the backdoor Roth has not gone away. This is a strategy that not as many people utilize as it probably should. But the other aspect that we were worried about is they were going to take away just Roth conversions in general, not allowing you to convert from a traditional IRA to a Roth. Now they've put some stipulations potentially where it's going to be a 10-year window. Then they start that, which really it's kind of interesting, and it befuddles me a little bit, Lance, because you would think about it that this is actually one of those things you think they'd want to get their hands on the money now. So doing a conversion should typically be a good thing.
I'm not sure politicians actually think that far down the road, but we'll talk about some more. When we come back from the break, the 60-40 allocation model, it has been proclaimed to be dead now for the last decade, yet it's still here and it's still working, and depending on how you invest your money, can work very well for you. We'll talk about that. Is it dead? When we come back from the break with Danny Ratliff. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and market, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know that we've gotten to the peak mania point when you see everybody rushing out now to do a SPAC, special purpose acquisition vehicles. A-Rod has come out with his own SPAC. Colin Kaepernick has one. Shaquille O'Neal has one. A new one out this morning. Climate change crisis is real. You want to raise money for a cause?
Listen to the Real Investment Show podcast from your favorite service.
Start a SPAC.
Same show, your schedule at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Is the 60-40 portfolio allocation dead? This has been one of the big discussion points that has really been in the markets over the last several years. Beginning in 2013, Jeff Gundlach, Bill Gross, others, the famous bond gurus, were proclaiming that the bond bull market of the last 40 years was over and interest rates had nowhere to go but up. And ever since then, rates have done nothing but go lower. And of course, as interest rates fall, the prices of bonds rise, which has made the 60-40 allocation model actually continue to work very well for more conservative investors. The 60-40 allocation model, 60% stocks, 40% bonds, has lower volatility than the S&P 500 index as a whole. And until just 2 years ago, about 2019, the 60-40 allocation model from 2000 to 2019 actually outperformed the S&P 500 index. And that was because of the two big bear markets in equities that occurred from 2001 and 2 and 2008. That really impeded returns for equity investors. They didn't get back to even until 2013. The 60-40 allocation model was well positive in making money for investors with much lower volatility long before the S&P 500 index got back to even. So, is there a point here where now, well, because interest rates are low, the theory is that rates have nowhere to go but up? The problem with that is that higher interest rates are a problem when you have an economy driven solely on debt, whether it's corporate debt, individual debt, mortgage debt. government debt. Everything that we're doing is specifically going right back into debt to pay for whatever we want to pay for. Of course, that's all been a function and a driver of near zero interest rates now for the last decade from the Federal Reserve and continually falling interest rates, not just over the last decade, mind you. Interest rates have been falling since 1980, which has been fueling both speculative investment in markets as well as rising asset prices in multiple areas. So, yes, interest rates can't go much lower than zero, but does that actually mean the 60-40 allocation is dead? Now, before I ask Danny Ratliff a question, I want to read to you a little quote here from a Barron's article. And this article basically says the 60-40 allocation model is dead. It's done. And here is the resolution by people, advisors in the marketplace, what they're recommending for their clients. And particularly, we're talking about now clients that are near retirement or in retirement with a substantial amount of wealth saved up. What's the recommendation to combat the 60-40 allocation model if bonds are indeed dead? With longer and longer life expectancies, the retiree depends on their portfolio to meet their living need for decades. Therefore, for most clients, the assets that would typically be invested into bonds should be invested into equities. So in other words, as a retiree heading into retirement, you should no longer have fixed income as part of your portfolio. Your portfolio should be 100% equities. And this has become commonplace, accepted analysis and recommendations for the markets. And the problem with this, of course, is this analysis and recommendation has come from a 11-year bull market run where there's been no serious major declines to this point that have impacted capital. Ask somebody that was actually in the market in 2008, and they might disagree. Danny, let's go to you. You work with a lot of individual advisors. You're a certified financial planner, and you work with many, many high net worth clients. I just want to ask you a question right up front here, Danny. If you went to one of your clients right now and said, "Hey, Mr. Smith, we don't think bonds can go much lower here, so we're going to put all your money into equities," would you still have any clients?
I think that'd be a really hard sell. But Lance, there are a lot of people out there that are doing just that. And they're making the argument saying, hey, you know what? You have a long time before you need to make distributions. Go ahead. You can put these funds aside. We can be extremely aggressive because there is no other place, no other alternative at the moment. And we know that's not true. The other issue is, like you mentioned, 11 years, 12, 13, whatever the number is, as far as this bull market has ran. What's likely to happen is the market gets more and more expensive as we are in a potentially tightening cycle that typically doesn't bode well for equities. And so now you have somebody getting closer to retirement. Yes, they don't need these funds right now, but what if you saw a major drop? Would maybe they start to have to rely on these funds down the road? Mm-hmm. There's potential for that. And I think that becomes the bigger problem here is that with this greater amount of risk, that we're trying to kind of smooth over and say, look, guys, it's going to be okay. It seems like that's what the industry's doing. There becomes a significant problem for the well-being of your financial plan as far as how long these funds can last you if you face a significant drop. And most people aren't taking that into account.
And that's really kind of a key point here is, again, there's two things that happen to retirees. And again, if you go back and talk to a person that was in the markets in 2008, as an example, and was close to retirement. Say they were just within 10 years of retirement. Or let's go back to 1998, 1999 and talk to somebody that was within 10 years of retirement back then. Let's say you're 45 or 55 back in 1998, 1999. It was 13 years before you just got your money back. If you weren't ready for retirement in 2013, you still weren't ready for retirement. And that's 13 years of your lifespan that just kind of went away because of what happened with the market cycle. And, as we talk about valuations, and that has a lot to do with forward returns, PE valuations at the peak of the market in 1999 were 44 times earnings, according to the Shiller Cape. As of yesterday, the Shiller Cape ratio is 40 times earnings. It is only, basically 4 points less than it was in 1999. And yet we've got advisors saying, oh, well, the only thing you can do here is put all your money into the riskiest asset class of the market, which is equities, and kind of really just kind of cross your fingers and hope markets just keep going up indefinitely because we've now eliminated bear markets. And this is the thought, at least, by individuals when it comes to the Fed. The Federal Reserve will not allow the bear market to occur, so there is no downside risk to markets. We are in very uncharted territory in terms of valuations. Price to sales have never been at 3 times earnings. Market cap to GDP has never been at 2.5 times the economy. Talk about valuations, 40 times earnings. That's the second highest level on record, and very close to what we saw at the peak of the markets in 1999. No matter how you cut valuations, investors are paying a very high cost for that. But bonds, relative to the economy, are still actually very fairly valued. So as an investor, really, where would you put your money? Seems to me you're taking a lot of risk to try to eke out a very small rate of return differential going forward.
Well, I think what advisors are looking at is that they can look like a rock star in the interim and say, okay, we can gather assets. We're doing very well. It's a good story, because people don't know what to do. They understand that we are in uncharted waters to some extent. But what I fear is that on the back end of this, they're going to look like MC Hammer, broke and not have any money. And this is going to pose such a significant issue for retirees. And, just like you mentioned, you have a totally different perspective when you think about the people that retired in 2000 and they faced 2001, 2, and 3, or 2008, and you saw that significant drawdown. We know the first 2 years in retirement are extremely crucial to the longevity of your funds. The first 10 years are also really important. Once you get past those, if you have the wind at your back, you're doing pretty good. But it's a different story for people who took distributions during those times versus people who are able to take advantage of it, put funds aside, continue to contribute as the market dipped. Hey, that could have been a really good thing for a lot of younger investors, because now you're buying it a lot cheaper, and now you do have the wind at your back.
Yeah, well, and that's kind of one of the excuses for this as well, which is, well, even if the market does have a big correction, it always gets back to even, right? It always comes back, and that's true. But one of the things that retirees in particular, miss in that statement, which is, as the market is declining, if you're taking money out, you're accelerating that decline. So if I'm taking out 10% of my assets a year to live on, and the market declines by 10%, I'm not down 10. I'm actually not down 20. I'm actually down about 22 because of the effect of compounding of those withdrawal rates as the market's declining. So, for a lot of retirees, the one thing we always recommend is having some cash cushion set aside so that during a decline you can stop withdrawal rates to minimize that impact on accounts. But for people that are 100% invested in equities, they may not have a choice, and that devastation may actually be even far worse than what happens just in the market decline, and something that a lot of advisors don't tell people about.
Well, that's right. And what about the advisors that are now pushing these more sophisticated products? That's one of the things I'm seeing is, even reading that article, other areas, it seems that this is the hot topic. But now we have people, and we've had to think outside the box as well. I think that this environment, it needs a time to think outside the box. But you have to be very careful, and people need to understand what they're investing in the sense that we're seeing a lot of people throw around private equity, private real estate, things that a lot of people typically would not have looked at. Now they're saying, okay, this is something that I could potentially do. And it is that more sophisticated. We talk about all these products that Wall Street, bundles together to sell, and this is one of them. And so that's another area that I think investors need to be cautious. They need to do their homework, make sure they're doing their due diligence to really understand what they're investing in, understand if there could be potential liquidity issues. What's the impact if the market does falter and the economy, goes it looks a little bit different, because that's when those investments, they're not nearly as fun, because you can't get out and you can't actually proactively manage that portfolio, because more often than not, you're stuck in some of those.
Yeah. So is 60-40 allocation model dead? No, the answer is it's not. And even if bonds go nowhere over a decade in terms of price, you're still better off than being 100% invested in equities during a bear market. And it's just simply a function of math. But most importantly, it's about risk tolerance and what you can actually afford to navigate and how to mitigate that risk. So again, make sure you get with your advisor, talk to them seriously about the impact on your retirement. If you have questions, go by our website, realinvestmentadvice.com. Send me a question. Danny and I are happy to answer it for you. Be right back after the break. I'm your host, Lance Roberts.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and market, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. I'm your host, Lance Roberts. Danny Ratliff, certified financial planner, joining me as well. So I want to follow that last segment up. We're talking a little bit about the 60-40 allocation model. And of course, you know, it's all coming down to this idea that bonds are dead and the bond bull market's over. Interest rates have nowhere to go but up. The problem is interest rates can't go up, because if they do go up, then all of a sudden people can't afford to buy, can't afford to they won't refinance their mortgage. They won't buy a house. They won't be able to afford to buy a car. Variable rate interest payments on credit cards go up, so that distracts from other discretionary spending in the economy. Corporate debt goes up, and of course we have a lot of zombie companies depending on low rates to finance, and if they can't refinance at low rates, we have a lot of companies that go out of business. All of that is very recessionary. And of course, once you get into a recessionary environment, interest rates begin to fall again. So again, interest rates can go up a little bit in the near term, but they can't go up a lot because of the economic impact of a extremely indebted economy. And that's the one thing that everybody talking about higher interest rates misses. And this is the one thing that is important longer term. But in the near term, and how we manage our portfolios for our clients, is that we use bonds to minimize volatility. So when interest rates rise up a bit, we shorten our duration to minimize the impact of rising rates. And when rates peak and we get a buy signal on bonds like we had recently, well, then we extend that duration to take advantage of that decline. So just like managing, and this is one of the big problems with buy and hold investing as well, is that, when you talk about the 60-40 allocation, all these, advisors are saying, oh, you're just going to buy bonds and sit on them and just kind of ride the wave up and down. And, that's not really how investing works. Investing is about finding opportunity, take advantage of opportunity, and managing risk over time. And, buy and hold is an easy way for advisors to gather assets and charge you a fee for doing nothing. You should be wanting to find an advisor that is, working for their money, so to speak, and managing risk and making sure that you reach your financial goals over time. But that brings up another point, which is making sure that the money you've saved will actually last through your entire retirement. And, Danny, there was an interesting article about this by Robert Powell asking this question and how to make sure. And, this is one of those kind of, as we were talking about kind of in the last segment, is there's a lot of things that can impact your money. And the one thing that most people, in the financial industry dismiss is the impact of a major bear market. Will your money last through your entire retirement? Sure. As long as markets are generating 8% a year, you're going to be just fine. You can take out 4, you're all good. They fail to compensate for a major drawdown in the markets of even 10 or 20%, which can have a big impact on how long your money will last.
Well, that's exactly right, Lance. And so we're seeing all these different ideas of how to make your money last. We look back at the 4% rule. We know that rule should probably be gone considering where interest rates are. That was invented, decades ago when interest rates were much, much higher than they are today. So retirees are having to become a little bit more flexible and nimble with this. But, to our conversation last segment, it is pushing people towards equities because you can go find an equity that's going to pay you a very similar yield or even better than what we can go find a good bond right now. And so we talked about years ago, I can remember back in the early or mid 2000s, investors felt like they're between a rock and a hard place. And I can remember finding CDs or other fixed investments at 5 and 6%, and people are kicking and screaming, saying, "This is terrible. I don't want to do it." And now, when those matured 5 or 10 years later, they're thinking, "Oh my gosh, what am I going to do?" Because there's nothing out there now. And so you are really between a rock and a hard place now. And we're hearing so many different ideas on how to invest and what this means. And, I think it's great that people are beginning to think and say, okay, maybe just, this buy and hold isn't what it once was. I think that's what's promising is coming out of all these conversations. Because we know, just like you mentioned, people need to earn, and advisors really need to earn their keep in the sense that you need to actively manage funds. If you're not with an advisor who's actively managing things, life has changed because markets move so quickly. The environment has changed drastically considered from where we were years ago when you go buy a handful of mutual funds, set it and forget it, and not worry about it. I think you need to be much more nimble than that at this stage in the game. But to your point on this article, one of the things they mentioned that I thought was interesting was putting a significant portion of your funds into tips. So that would really suggest that we think that interest rates are going to continue to go much higher. Inflation is going to stay there. It's not, that it is truly permanent and not transient, or what the Fed says. And what happens though to an investor if you do see some deflation and you're owning these tips?
Right.
Then you're not making any money.
Yeah. Well, but again, this is where it comes back to, the reality of how markets work is that everything cycles. I mean, you're going to have an inflationary cycle. You're going to have a deflationary cycle. You're going to have a bull market. You're going to have a bear market. Everything cycles. And so the important thing is to understand what those cycles are and then to make investments according to those cycles so that you can both, make money, which is important, right? We all want to make money, but the most important thing is protection of capital. And, if I protect my capital, the gains will take care of themselves over time. The biggest mistake that investors make is losing 30 or 40% of their money and then spending 5 or 6 years of gains just to get back to even. Getting back to even is not the same thing as making money. Plus, and again, let's go back to what we said in the last segment about kind of the average advice from the financial media is that markets always come back. Yes, they do. But if your retirement plan is based upon 8% a year income and you're going to make 8% a year on your money, if you lose 30% of your money, then spend 5 years getting back to even or however long it takes, you still have to not only make that 30% back, plus all the 8% that you were supposed to make those previous years compounded on top of it. So it's far different. Actual returns and actual outcomes are far different than market outcomes and average returns, which are generally thrown around in the markets a lot in terms of analysis. It's important to look at the impact of gains and losses and compounded rate of returns on your actual retirement plan when those things occur and to plan for them in advance. What happens if one of these things occurs? What happens if we do have a market downturn? Hopefully we never will. Hopefully the markets will go up 10% a year and we'll all be happy and it'll all be great. But what if you actually happen to have a downturn, and how do you navigate that? And that's got to be part of the financial planning process.
Well, it does. Unfortunately, most people just think of it in the number perspective from percentages on gains and losses. They don't ever think about it as far as what that means to their actual lifestyle. What does that mean? Do I have to take a reduction in distributions and live on less? Because if you want to get back to where that high water mark is, and let's face it, Lance, I mean, I talk to people day in and day out, and if the market goes down, for instance, in September, market went down 5%. Our portfolios were down significantly less. But what people look at is say, well, man, back in August, I was at this amount. Now I'm down here. I'm way down for the year. Whoa, we're not down for the year. You're down from where you were. You're actually doing really, really well for the year. And so now you take that same mindset. You actually have a negative loss, and then you're taking these distributions. And most people aren't prepared to actually take a pay cut, and that's the issue. And so when we talk about how to make these funds last, you need to be flexible as far as what you're willing to do. You need to understand from a financial planning perspective, what are your non-discretionary expenses? Many people say, I don't want to do a budget. Here's my expenses. Well, hold on. Let's take a deeper dive into this, because we need to really understand, here's what your non-discretionary expenses are. Here's what your discretionary are. If something bad happens in the marketplace, and it's going to happen. Nobody's taking recession out of the business cycle. So at some point we will see this, and you may have to make a change. Now, maybe the plan is accounted for it. Maybe we've been prepared and we've been extremely conservative. We stress the funds. You're going to be okay. Or maybe we need to go in and we need to make a change. And I think that's the conversation that people need to be having with their advisors. They need to understand what happens and what the overall impact is for them.
Yeah, and look, and this is one reason why, I understand that cash has no return right now. Having money in a money market account has no return. I get it, right? It's terrible. But having cash also gives you a lot of flexibility. And, this is one thing that I talk to a lot of investors about is, look, if you're living on your investment account, have a good cash cushion sitting on the side that you can go 6 months or a year without having to take withdrawals from your investment account, because that will allow you to help mitigate downturns when they do occur. And it gives you that, as you're talking about, it gives you flexibility without having to sacrifice your lifestyle. But, we've gotten everybody in this whole mindset that the cash is terrible. It's just losing money sitting in a bank account. Yeah, theoretically it is, because if you go out and buy a bag of Oreo cookies next month, it's going to be 10% higher than it was last month. Hey, I get that. But having flexibility by having some cash is extremely beneficial. It also gives you opportunity to do things. If markets do go on sale and you've got cash, you've got the ability to buy stuff cheap, which is the whole benefit of investing in the markets. Buy low, sell high. That's what we're supposed to do. And if you have no cash because you're buying and holding investments, when you do have a big downturn, great. You just lost a bunch of money with the downturn, but now you have no cash with which to buy the bottom with, which is what everybody talks about. Oh, I bought the bottom. No, you didn't, because you were buying and holding investments.
Yep. Well, that's exactly right. That flexibility that most people don't have, because they're stuck in hey, you have to be all in. You put everything into it. And then, when you're ready to get something out, unfortunately, it's usually at the inopportune time when markets are really bad. You think, oh my gosh, I have to get out of here. I need some cash. I need to pay bills. I lost my job, whatever it may be. In these economic times where things are, we have a lot of turmoil. Those are things that's real life. That's what happens.
Yeah. So we need
to prepare for it.
Right. So maybe Elon Musk wasn't so stupid selling 10% of his stock at all-time highs, right?
Well, yeah, I think that's a pretty genius move. But didn't he also have some stock options that were expiring?
Yeah, he's in good shape. $20 billion. Yeah. He's fine.
Poor guy.
That wraps up the show for the day. I'm your host, Lance Roberts. Danny Ratliff joining me as well. Be sure and tune in this Saturday for our Candid Coffee. We're going to talk about the market outlook for 2022 with myself, Danny, and Richard. Be sure and register on the website now, realinvestmentadvice.com. Send us your questions, comments, got our latest blog post and more, all at the website, realinvestmentadvice.com. See you back here tomorrow.